Everyone, please say hello to Joe, Mark, John, and Adam. Hello, Joe, Mark, John. So I'm really excited about this panel because we have a bunch of people who are super experienced in M&A from various sides of the deal. So let's kick it off with some introductions. So if you could all tell us about yourselves and sort of your M&A bona fides.
Got it. Hi, good morning. My name is Joe Bardenheier. I head up corporate development for a company called the Endurance International Group, which is a publicly traded firm based in Burlington, Massachusetts. We've been in business for about 19 years. The brand Endurance we don't market under. You may have heard of some of our other brands, Bluehost, Domain Host, iPage, Domain.com, and most recently Constant Contact. We've done about 80 acquisitions. I've been involved in about 80 acquisitions over the last 15 years, to the tune of, say, about $1.75 billion in value. The most recent one was Constant Contact about a year and a half ago. We bought for about $1 billion.
A small little deal.
Give or take. Roughly 5.5 million SMB customers waiting towards the VSMBS side of things.
Thanks.
Hey everyone, my name is Mark MacLeod. I'm the founder of SurePath Capital Partners. We are the leading strategic financial advisory firm focused on SMB software, so we help SMB companies raise growth capital. We help them exit. Prior to founding SurePath, I spent 14 years as CFO for a number of companies, most notably Shopify and FreshBooks. Also spent 3 years on the dark side as a VC, investing mainly in SMB SaaS. And as for I guess my whatever you called it, M&A kudos, we were the sell side advisor. Our most recent deal was SweetIQ's sale to Reach Local. But I've done tons of exits in this space as an operator, VC, and now as an advisor.
And you were saying that you started your firm. And when did you start SurePath?
Just over 2 years ago.
Yeah, and you said you didn't see any iBanks out there that were doing this, or any that were kind of legit or something.
Hey, you've just given me like a softball right down the center of the plate, so I'm gonna have to take a swing here. When I look at most of the boutique banks out there, if I stereotype, there were a bunch of middle-aged white guys in navy suits, all broadly covering TMT. My apologies to any bankers in the audience. And they just all look the same. And I just think the world is becoming increasingly specialized. And both in terms of the world is small, you can talk to anyone, but to truly understand how to make a company work and how to make deals happen, I just think you have to be specialized. And so we've chosen SMB software, including local, as our specialty.
Okay, great, thanks. John.
John Sofield, Google, business development. I don't do any corporate development at Google, though.
We're still happy to have you.
Thank you. My sort of experience, first of all, I was acquired by Google, so that was an experience. And prior to that, I did 7 or 8 years doing consulting work in M&A, working with a number of small companies.
Right, and then you're also in the marketplace seeing all of these companies out there from a partner standpoint as well. And
we do, and it's very busy right now.
Adam.
Hi, so Adam Burrows, run corporate development for Homeadvisor, among other responsibilities. And for those that aren't aware, Homeadvisor, we're the largest marketplace connecting homeowners and home improvement contractors. We've done, I think, 6 transactions in the last 4 years, and the 7th will be the biggest, which is our recently announced acquisition / merger with Angie's List, which will close in the 4th quarter.
Great, thanks. Also, fun fact about Adam, he is part of a growing mafia in local of corp dev people, or maybe there's 2 of you, but there's probably more. So Mike Afari at Yelp, also head of corp dev, and Mike and Adam were at HBS together?
HLS, law school.
HLS?
Yes. Okay,
nice. And both are doing acquisitions in local, interestingly enough. So thanks, guys. Really psyched to have you here. Want to start off with, this has been kind of a pretty big year for some big exits. Yext, Placed, and of course, Angie's List to Homeadvisor. So do you think we're going to see more of this? Is this on trend for the year? Big acquisitions. Mark, why don't you take
Sure,
that?
I'll jump in. I still think that most of the volume is going to be smaller acquisitions. When I look at the statistics, both for local SMB in general and software more broadly, like over 3/4 of exits are deals that have no disclosed value. Sometimes those are large deals. It's just that the buyer is so big that on a relative basis they don't need to disclose. More often than not, the deals are small. I think. Not to depress everyone, but if you read TechCrunch too much, you think that inside 3 years you're going to sell your company for $300 million, and it's just not the reality. Most acquisitions are small. That being said, the biggest challenge in local is distribution, right, and reaching scale. And so the companies that you just cited all have reached scale.
Right. Yeah. No. Who was talking about how I think Adam, you and I had a conversation about how we're kind of past this point where you can't start a business and just get some traction. You need scale for them to be appealing.
That's right. I think that the days of just starting something and getting a handful of customers and saying we've got great technology, it's proven, and getting bought are over, at least from our perspective. We really want somebody, when we look, somebody that's really proven they can already do it at scale, and we'd rather pay up, and I think you see this in other companies too, pay up for somebody who's proven that versus taking a chance that it's going to happen because it is so rare and local.
Yeah. So, maybe if you can talk a little bit also along those lines about like your deal process, like what's the justification for a deal?
Sure.
Do people come to you? And then Mark, I'm going to want to jump to you.
Sure.
Off of that as well.
I can speak to our company, obviously. So the 6 deals, and Angie would be the 7th that we've done. None of them were brought to us in terms of a banker just coming and saying, hey, there's a company for sale. Are you interested, right? They were all situations where we knew the company, we were pursuing it. It was part of our core strategic objectives. Not that we don't look at everything that comes our way, but I think it's very tough to go to market cold and just say, hey, we're for sale, and expect to a strategic buyer who you want a premium valuation from to change their course of what they're doing to buy your company. I think the best thing you can do is to partner with a company, build that value, show who you are and what you can do so that you're already on their radar when their strategic priorities allow.
Mark, I want to jump to you a little bit on that. You'd like to talk about optionality. I feel like that dovetails with that, and then I want to get to you guys as well.
Yeah, very much. I mean, Adam's raised a great point, right? Strangers very rarely marry. I think, dating before you marry, having pre-existing relationships makes all the sense in the world. And so we realize that so much so at SurePath that we really try never to run auction processes and go to Joe and like, hey, Joe, how would you like to buy this company you've never heard of before? Why don't you just go ahead and drop everything you're working on and do that? Like, that's not going to turn out very well. But instead, we like to have ongoing relationships with our clients and kind of accelerate the normal kind of product owner and biz dev and GM conversations that would lead to inbound intent. And at the same time, we're making sure that, the company is on a path where if it's not already cash flow break even, it could become so. We want to make sure it has the revenue, run rate, and unit economics to be able to raise capital anytime it wants to. We want to make sure that it is known to all of its most natural buyers so it could enter into a qualified sale process anytime it wants to. That is a world where a company has optionality, and that optionality, to me, creates value.
Okay, Joe, talk to us about some of your 80 transactions. So what are some of the qualities that you've looked for or needed in a target? Or, has that been the approach of, I guess I kind of have 3 questions for you. The kinds of qualities you look for in a potential acquisition, the potential seller. Also, how often and in what situations you are looking for a target, and how often, and I realize we're talking about 80 over the course of 80, and then how many, people come to you and they have something interesting. Yeah, take all of those.
Yeah, okay. Yeah. So first of all, if I were to try and categorize the 80 deals that we did, some of them felt so early on. What Endurance did is basically consolidated the SMB web hosting and domain namespace. And so we believed that the best way to get to scale was through inorganic means, meaning that we were going to purchase customers of our competitors, ideally smaller, sometimes bigger, try and integrate them or migrate them to our platform, which we believed had a lot of economies of scale because it was built out in a very efficient manner, details of which we won't get into, and turn $1 worth of revenue into 50 cents worth of profit. So we did a bunch of those along those lines. So we then got to a stage where we felt like we had scale, and then our focus broadened a bit to where we then were in what I think is a similar situation to what's happening in the market today in this particular category, is that we felt like we needed to then figure out how to expand our ARPU. We had the attention of the customer. We wanted to be able to cross-sell and upsell them more products and services. So then the choke opened and we started to analyze a variety of acquisitions or a variety of potential partners, to sort of expound on what Mark's saying. First off, establish these relationships, and then if they turned into an acquisition, then it would happen in that manner. But I want to reinforce that the process very often is not. I mean, I get inbounds all the time, and iBankers will come to me all the time. They'll be like, "Hey, this makes total sense," and intellectually, it does make total sense. But I'm unfortunately not. Unfortunately, I'm not the guy who makes the ultimate decision, and more importantly, I'm fortunately not the guy who ultimately has to operate the acquisition and get the real value out of it. And so I have to talk to my business development team, my product teams, my strategy teams, all the folks who need to ultimately make the determination of whether or not this is going to provide value. And to Mark's point, if there's a partnership that happened months or years there prior, then it's that much easier in a decision.
Right. You know about the product fit, the culture fit, processes, whether it leads to is a good business sense. Yeah. Adam, I see you're nodding your head. I don't know if you had anything to add there.
No, it's absolutely true, right? You've got to build so much trust and consensus internally on this stuff that having past relationships is invaluable. To Mark's point as well.
Yeah. Okay. Cool. So I mentioned a few of the big exits this year, but there were some big ones last year as well that were sort of huge in this space. Gannett and Reach Local, and Web.com and Yodel. And John, you and I talked about this a bit, about, just talking about, why they did it and the means, or the sort of the thinking behind it and the need to do it. I wondered if you could share some of your thoughts, because our very cheery John Sofield actually had some very positive thoughts on these things.
Well, I think it's always easy to be more negative, right? So we can steer this conversation towards a more conservative approach to M&A. And I think that our challenge is that in this industry, right, we have those that are incumbent, that have done a tremendous job in acquiring a large-scale base of advertisers, merchants, whatever, subscribers. Yet most of those larger companies struggle with innovation. And I think in the case of, and then this is often an occurrence within what I do in business development for Google, is we work with many, many different partners, and the landscape is changing, and it's changing really fast. And where this is changing is that there's a greater need for real innovation, and larger companies struggle. Google struggles to a degree because of the size of our business.
Struggles in what sense? Sorry.
Pardon?
Like struggles in what sense?
In a sense of just fast innovation. We're not a startup, right? So things take time, right? And where, if you look at Gannett is, for me, is mainly known as a media company. Now I know they've got a history of technology, but if they were looking to solve a problem, did they go and build that really themselves? In regards to creating a a ubiquitous platform for advertising and fulfillment, or do they buy Reach Local? And it was a way smarter acquisition to do that than try and test their own people to build something. And I think that's a very common occurrence today in many of our partners, is that they have great engineers, they have great product people, but they're not the people that you would typically hire to build the things that they are looking to build. So acquisitions is an essential part of growth. And my biggest concern for us as an industry is being overly conservative. Because
Overly conservative.
well, because of fiscal responsibility within businesses doing the acquisitions, that, like you said, you're getting lots and lots of approaches from iBankers, and like I said, there's hundreds of them, right? And they've all got a great case. But there's probably 1 in 100 that's actually really is a good fit, but you just didn't quite know it was. And my point is that in this audience and beyond this audience, there is some really innovative, smart people that are doing really disruptive work, and they're really struggling, right? And our industry needs that impetus to take the legacy that we have and move it forward. Because on the horizon is a significant shift, is a change for all of us, including you.
What are you referring to?
We're going for, we're not going, but we are seeing this approach of a walled garden within, particularly mobile, that really changes the landscape. And in some ways, if you are selling domains and you're doing websites, right? If you're in a sort of ubiquitous model for advertising across multiple locations, and you're competing against a walled garden, it becomes, together, it's a challenge for us, right? I mean, all of us in the industry, right? It's like that becomes harder for us to penetrate.
Sure, but I mean, we're seeing the walled gardens actually the ones who are doing more of the acquiring, right?
Yeah.
So, yeah, so that makes a lot of sense. So along those lines, are we? Is there an expectation that we're going to see? Do you guys think we're going to see more activity along those lines? Just more roll-ups coming. Is that either what you're hearing or just your sense?
I'll jump in. I think M&A activity in this space mirrors actually the formation and kind of death of small businesses themselves, right? There's 3 million new businesses started every year. There's a similar number that churn out every year, so the market grows a small little bit. I think it's the same thing for exit activity in the space. I kind of ran a few numbers before coming here today, and there were 180 exits in the local software space in the last 4 years. And but most of them are kind of folks that you've never heard of, right? And so I think you'll see lots of that. I think every big buyer these days has a checklist to go out and find a machine learning, artificial intelligence story, right? Their board has said, what are we doing for machine learning? So you'll see that. That's going to be a theme as well.
The challenge is that you've got, and no offense to the companies who are here or not here, but we've got a number of companies that are trying to sell into the SMB space who've been at it for a long time. So there's just pure, they haven't been able to get the scale, there's frustration, and over time, they started as a product company, but they've sort of, because the market has moved underneath them, they're now much more of a feature than anything else. So you've got this interesting dynamic where you've got a feature company that's presenting themselves as a product company. You've got product companies that are presenting themselves or pretending to be platform companies. And you've got a lot of noise going into the small business owner who's sitting there, who actually over time has become relatively smart about what it is that they want to or think that they're going to get value from. And so they're identifying this, but there's so much noise because there's 40 different companies trying to sell them this feature separate from this feature, separate from this feature, and they just throw their hands up and say, online marketing, I'm already doing that over there with this company, not realizing that the conversation or the feature that they're getting educated about is actually something entirely new. So, the moral of the story is, if we're ever going to ultimately offer real value for the customers that we truly believe we got in business to serve, you have to do it in a manner that is at scale and ultimately sort of softens that confusion for our
Right.
customers.
Although, you know, I mean, a feature is also valuable, you know, right?
I'm not denying that.
I feel like sometimes the issue can be around the perceived value on the part of the seller, right? That's a big issue.
I think another thing to think about just on this feature thing is where that product is on the adoption life cycle. You know, early adopters are very happy to go out and search for that best of breed ISV who has the coolest new thing. But I would argue that the early and kind of late majority in markets would prefer to buy kind of one fully integrated suite from a trusted larger vendor that maybe is 70% as good as each of those individual best of breed things rather than trying to roll their own solution together.
Well, Adam, let me ask you this, because, I mean, we're kind of talking about a company like yours, and you guys have to make the decision on, you know, buy, build, partner. How do you make that
Yeah,
call?
I think, and maybe this is where you're going. So, some of the companies that I like that dynamic of kind of feature versus product, because we definitely see that companies that are really just a feature, and they may be a great feature, at least in the last few years, have raised quite a bit of VC monies to as if they were a product or a fully formed scalable company, and they're not. And so then you've got valuations that are just completely out of line, right? It may be an interesting feature, but we're not going to buy it for a price that is a platform or a company. And so I think companies, you know, really it's tough for startups to figure out exactly where are they going to fall in that continuum and then raising money accordingly. Yeah, I think that's the thing that we've looked at a little bit in the buy build partner. And we've ended up building a lot when it comes to features because of that. And when we've bought, it's been when companies truly are a differentiated platform. In our estimation, a lot of international expansion we've done through acquisition.
That's interesting. That's interesting. More of your acquisition has been international, or you're saying that's a way, that's been a very useful mechanism?
Most of our acquisitions have been international because of that. Because, you know, as a platform in, for example, our most recent one was in Canada. We acquired a company called HomeStars that's the leading platform in Canada because they actually are a platform, right? It's not just a feature on Homeadvisor US to have a Canadian website. It's actually its own standalone business platform and justifies the valuation that they wanted and that we paid for. We have not had any luck finding features, right, at a compelling valuation that have actually proven themselves to be effective.
Well, what is that dynamic like? I mean, at some point, you know, they probably need to make a call about whether to sell or shut down, right? You guys wanna take this?
Yeah. So, you know, CB Insights published some interesting data about this kind of VC funnel, right? Like 42% of, this was SaaS broadly, but 42% of SaaS companies that raise a seed go on to raise a Series A, and half of those go on to raise a Series B, and so on. And at each stage, you know, some of those companies die, some of those companies have real exits, some of them have fake exits, you know, where they celebrate it, but nothing really happened. And yeah, sorry, it's a pet
Celebrated, but
peeve.
nothing happened. I like that.
It's a pet peeve.
Yeah.
And so, you know, I think, and Adam said it earlier, right? You know, these companies that raise VC dollars, I think it can be, I think it's celebrated too much, and companies can raise too much capital and actually take away the few exits that might be available to them, whereas founders, they could actually, you know, have a financial outcome that would justify everything that they put into it.
Okay.
We've seen that a lot. We've seen that a lot of when we've looked at certain companies. We've actually, of all of our 6 acquisitions pre-Angie's List, none of them had ever been VC backed. Not because we have a bias against VC backed companies, but just as you go through the process, the valuations, at least in the last few years, have just been completely out of whack. Companies that are successful, that are VC backed, they want, you know, kind of what we would consider outrageous valuations, at least as a public company that have shareholders and have our own multiples. Whereas companies that do want reasonable valuations aren't even companies; they're basically on the verge of failure or have already failed. So I think it will correct, but we haven't seen it yet.
Just to pile on one very quick thing, when I look at the distribution of exits by funding status, like in SMB software, there are more companies that exit that are bootstrapped than not. which is different in other categories. And I think that just reflects sort of the evergreen nature of SMB, right? Most software categories, like, again, there's 3 million new businesses started every year. Every one of them needs a domain, needs email, needs a website, et cetera, right? So those are enduring markets. So you don't have to pump your company full of steroids on day one the way you would in other markets.
I mean, obviously there's an appetite for tech companies who serve SMBs, you know, Angie's List placed, you know. So it definitely is there, but I hear what you're saying, and I do hear it a lot. VC-backed startups are kind of not as interesting for people. But you also said, and I think this happened maybe with Sweet IQ as well, that you said you're often competing against like a VC round.
Yeah. So we haven't acquired VC-backed companies, but we've acquired a lot of bootstrap companies that are doing great, and they're saying, hey, I'm either going to go raise a VC round, I got VCs chasing me left and right, or you know, I'm willing to hear what you guys have to say, and we've you know, fortunately you know, been successful in a lot of those conversations.
Yeah. Okay, I want to. So actually, I just want to finish this up on the point of the sellers, and then I want to talk about where the money is. So let's see. I think you and I were having a conversation about, and we may have had this conversation as well, about how I think this fits into the features idea that either there are companies that are worth so much, and that's it. Like there's no other part of the market, right? There's not like a middle, your company has like a decent valuation and it's appealing to buyers. Am I articulating this?
There are sweet spots. So Jason Lemkin from SaaStr published a chart maybe a couple of years ago where like companies that are kind of sub $1 million in annual recurring revenue, that is a sweet spot where most of the deals happen where kind of product market fit has been established, but you're going to be either an acqui-hire or maybe some premium for the technology that you built. Then typically you raise a Series A, and you know, you're too expensive at that point to be an acqui-hire or technology buy, so you have to now prove out that you have a real business. And there's like this no person's land between 1 million and 10 million ARR where you're probably too expensive to get the premium valuation, to be a technology buy, but you can't yet command a premium valuation. Then around 10 million ARR, you very clearly have product market fit, but you also have clear channels for acquisition. You may have most of a management team in place, and so you can actually become a line of business for a buyer, and so that's another sweet spot. And then after which, if you raise a Series B, then all bets are off, and you need a Yodel type exit to justify that. Okay.
So let's move on to, because I want to get to some questions from the audience, because I'm sure there's going to be a lot. So I want to get your thoughts on, so even though I just said there's only exits for the big, super valuable companies, there's still potential for others. We've heard a lot about potential roll-ups. Want to get your thoughts on, who the potential acquirers are. You can name them. You can tell us all how much money they have for that. I've been hearing about PE a lot, and John, I know you had some thoughts on the PE.
I think the PE path is a well-proven path, and I think it's sustained quite a lot of this audience to a degree, in a good way, in a positive way. But neither do I think it's, if I'm a step back and looking for innovation, again, in our industry, and I think that's the key for our industry, is it can continue to innovate. I don't think it's encouraging real innovation. I think it's very profit-driven, and it's not in the venture sort of model, really looking at a little bit more around how do we disrupt, rather than just continue as is, right?
Okay, yeah.
I would totally echo that. I mean, to the point I made earlier around kind of SMB markets being evergreen, that's the type of market that a private equity investor loves. They're not looking for the 300% year-on-year growth, but they love to hold an asset that they can grow 50% a year, kind of more or less in perpetuity. But to John's point, they're growing that for cash flow, not innovation. It's not that VC J curve. It's, it's slow, kind of steady. I'm aware of, at least one PE roll-up in the marketing tech space. Fortress Capital, which is now SoftBank, has backed Propel Marketing. They've made their first acquisition. They're actively looking to make more. I think we're going to see more of that. But I think with some of the investments are actually exits simultaneously, where kind of early stage institutional investors are getting out, and it's kind of musical chairs, so it's an exit and an investment simultaneously, where you're replacing institutional investors basically.
So I would add, though, when you ask the first part of that question is where the money is, right? And I do not know the answer to that question, but I would challenge everybody in this audience is that some of the work my team has been doing is really sort of digging into sort of the legacy of where small businesses go for services, right? So often from a business development standpoint, there are very obvious candidates, right? So, and many are in this audience that I've worked with and continue to work with. Areas that we're really new into is like utilities and other services companies like FedEx, right? And UPS. These companies they're looking to change, they're looking to innovate. And I think that where it's more congruent for their businesses, they're not technology companies necessarily. And so there's an interesting fit. The conversations we've been having are really enlightening, right? They are as interested, if you're FedEx, you're as interested for your small businesses to be successful, and they have an invested sales force. There is an option for them to take on more services to push down that channel. And I think that there are interesting areas where I would challenge people, particularly startups in this audience, is to open up their eyes a little bit and sort of test whether it's in the financial services industry. These have been historically difficult. Telecom's really difficult. But they're all motivated. They're all moving. They recognize that they need to have add-on services that are supportive to their core business. So your choices are, if you're at an exit, you go to a technology company, and that's a cultural challenge. Two businesses merging, right? You just merging with Angie's List. I'm sure that's a challenging cultural fit. I mean, it's a huge challenge at Google. I mean, my experience was not a good experience. I mean, it was just a hard experience coming into Google because of the culture.
And when was it? How long ago? That was like 5 years ago?
6 years ago.
6 years ago.
Yeah, but it was because Google has legitimately, they put a lot of emphasis on the engineering side of it. And so, we reassimilate engineering into the Google engineering. So all innovation that was going on tends to sort of stall out until they are reassimilated into the area. And I'm sure it's the same with Facebook. It's the same, but other large tech companies that, to come in, you're typically going to have to marry those cultures.
Yeah.
Whereas if you're marrying a technology culture with a legacy service industry, there's room for the two to live autonomously.
I mean, yes, and then also challenges because they are different disciplines. Right? They are different specialties. So I want to open it up for questions, and if there aren't any, we'll keep talking. So do we have somebody ready with the mic? Yes. Anyone have questions? I can't believe it. Okay, so let's keep going.
We've answered all of their questions.
I know. We've told them everything. I guess I would like to hear, Joe, where are you guys in terms of appetite for acquisition right now? Is it something that you're continually looking for?
Yeah, the Endurance is in an interesting position where we've obviously done a lot in a long period of time and a whole lot in a relatively short period of time. We've to get a feel for sort of the transactions, both from the acquisition. We've done, in 15 years, we've done 3 rounds of private equity, probably refinanced the business through debt 15 times. We've gone public, and we've done 80 acquisitions in 15 years. That's a lot to do, and so particularly around sort of the last 3 years, what's occurred is that we, going public, by the way, is a really, really interesting experience, and as a child or my early, business entrepreneur career, I wanted to get a company to that stage, and I'm delighted that we did it, but it's really hard.
And you'll never do it again.
And I'm not sure I'd ever let's face it, if the stock price were a little different than it is today. I might be saying something differently, but it's really hard to manage a company and stay nimble and innovative and keep the culture and a variety of other things that go along with being public, and particularly in this day and age, sort of with all the regulation and everything else that goes along with it, but that's a different story. Yeah. This is a long answer to a short question, which is Endurance has got a fair amount of sort of debt, that tech debt, if you will, that we just need to sort of consolidate. So we are actively looking, always actively looking. The mandate is keep the pipeline open, continue conversations, particularly more because a lot of my pipeline gets passed over to the business development folks and the product folks. So it really is an interesting channel. So I work very closely with them around that. But as far as big acquisitions, Endurance is probably not doing anything until 2018.
Got it.
A quick.
Okay.
Quick
Okay,
answer
so
to
don't contact Joe until next year.
No, contact me for sure, but don't expect to get a deal done this year.
Yeah. And what about you?
I'd echo the same thing. I think our big deal with Angie's is going to close in Q4, and I think after that we'll be actually probably very actively looking at everything. We'll be a separately traded public entity, so we've got that currency. Our parent company IAC has over $1 billion in cash, so I think we'll be very, very active coming out of that transaction. But until that happens, we're not really doing much. We're doing a lot, but not on the M&A side.
Right. Well, you're also integrating acquisitions.
Exactly.
You and I talked about that a little bit, like how you make that successful.
Yeah, so Angie's is going to be interesting because it is such a big acquisition for us, and there'll be a lot of integration work and cultural challenges. What we've done in a lot of the smaller deals is actually keep them pretty separate. I mean, we've bought everything that could really be its own line of business and a lot of hooks in between and some cultural cross-pollination, but generally have kept every acquisition as its own business line, and that's been very successful. It's actually been a way for us that we've helped ensure that we've got a lot of innovation. We've kept some of these smaller companies independent enough where they can provide a lot of really cool technological developments for us that we can then roll to the parent company successfully. We've done that several times, and I think we'll keep doing more of that.
Okay. Last thoughts for companies in the room, kind of a crowded space. What's your biggest piece of advice on how they should, like what course should they look for?
Just to continue to execute, for sure. Continue to look at the top line and the bottom line. Figure out how to get your cost to acquire new customers down, and if your goal is to ultimately sell, then to echo these guys, find some good players to partner with because they're probably your more likely exit.
My favorite word, optionality. Make sure you have optionality for your businesses, that you're not running into a brick wall at 100 miles an hour, that you know what it takes to raise more capital if you want to do that, and that you are known. You're building relationships continuously with your most natural buyers. Even if, to Joe's point, he's not actually pulling out his checkbook today, these relationships take time, so start early.
I think the hardest thing of all is to get your pitch right. And I think
I'm sorry, get what?
To get your pitch right. I think that's one of the biggest challenges. I mean, I meet companies frequently, and when it takes more than 5 minutes for them to explain what they're doing. I mean, I'm always interested, but it's that first few minutes. And if you can really succinctly get out what it is your business is doing, then you'll get a lot more interest. And I think that's just a very simple thing, but it rings so true in the investment community.
Awesome, thanks. Adam?
Yeah, I would say to be open and transparent when you're having conversations with potential partners and buyers. We see this a lot where, again, it's all about trust, and if you are kind of being overly self-promoting and obfuscating things, people will ultimately see through that, and even if you have a great business, there's going to be a high degree of mistrust, and things won't happen.
Yeah. Awesome. You guys, thank you so much. This was an amazing conversation. Thank you all for your time. Thanks so much.